Hey Bowtie Nation, Joseph Hogue here, right there with you trying to make sense of this crazy stock market. Folks, after falling almost 20% into a bear market territory, then having the best upside run since 2004, stocks are now trying to find that next direction. Over 25 years investing and more than a decade working as a professional analyst, I've learned that these are the times that you need to dig deep into finding those right stocks to buy. Anyone can make money when everything is going up, but I found the 5 best stocks in the best sectors, and in fact, these stocks have an average 25% upside to analyst price targets. I'll show you how to find the best stock sectors, then how to narrow your research for the best stocks, then reveal those 5 top stocks to buy right now. We're going to start here with the big picture, the best sectors to be in over the next year, where analysts see the highest returns. And I know a lot of you out there are screaming, just get to the stock picks, but nation, you have got to do this high-level research before jumping into the stocks you're going to buy. New research shows investors spend just 6 minutes looking at a stock before they buy, just 6 minutes to make a major financial decision. Basically, most investors are just looking at a stock's price and then throwing the dice. And worse still, a lot of investors are just depending on YouTubers to tell them what stocks to buy. And you know where I think most YouTubers pull their investment ideas out of. Nation, you cannot expect to follow the herd and make money. Stick with me here. Give me just a few minutes in each video to show you the how to research your stocks and how to take control over your own portfolio, and you will make money. And here I'm starting with the potential returns by sector in this chart by FactSet Earnings Insight. The company surveys analysts on their target prices for every stock in each of the 11 stock sectors, from energy to tech, healthcare, and utilities. Then, comparing the upside from that current price of each stock to the average target price shows here the potential return in each sector. It's a great place to start because if we know that, for example, energy stocks are going to have a strong tailwind of 24% upside return, then most of the stocks in that group are going to do well. I'll narrow this down further to the best stocks in a few sectors when we look at the stocks to buy, but even if you don't pick the absolute best, you're going to make money if the entire sector booms like that. Folks, it is this big picture investing that is not only going to make you money, but is also going to make investing a hell of a lot easier. Instead of trying to pick 1 or 2 stocks out of the 5,000 traded on the U.S. exchanges, why not start with just a few hundred in those best sectors, then narrow it down from there? So we see that analysts expect nearly a 20% upside in 5 sectors of the economy over the next year. Communication services, which is your internet and telecom stocks. Healthcare, consumer discretionary, which is all those things we buy but don't really need, like toys and Vegas vacations. We've also got tech stocks and energy here, while at the low end, we see 10% and lower returns in utilities, consumer staples, and financials. And here, if you want to see the biggest stocks in each sector, you can by going to the sectorspiders.com sector tracker, a free resource tracking returns in each of the 11 sectors. And here, you just click through any of these to see the stocks in the S&P 500 within each group. Like here in consumer discretionary, we see those casinos, the Hasbro toys, and the cruise lines. Well, if you expand in the consumer staples sector, you see the things that we have to buy, like Brown-Forman that makes Jack Daniels, which is definitely a must-buy. So now we've got 5 sectors we might target to narrow down our stock search, but we're not just blindly rushing into analyst forecasts. We want to balance this with valuations and other data to narrow it down further to maybe just 2 or 3 sectors. For that, we can compare the sector-level PE ratio shown here in another chart by FactSet. This shows the price of every stock in each sector divided by the profit analysts expect that company to report over the next year. So it's the stock price divided by its earnings, how much investors are willing to pay for every dollar in earnings reported, and the most basic measure of how expensive a stock is. And this is going to go a long way to help us not just finding the sectors forecast to post the best returns, but also those that are already cheap and have the best chance of getting that return. For example, while analysts see a 22% upside for stocks in the info technology sector, looking at valuations, though, we see these stocks are already some of the most expensive in the market. Stocks in the tech sector trade for a price-to-earnings of over 21 times, that dark blue bar seen here. But what's worse is that 25x PE ratio is also 16% higher than the 10-year average PE ratio of just 21.6 times seen in the green bar. So not only are tech stocks relatively expensive, but they are priced for perfection compared to what investors have paid in the past. But then combining the info in these charts, we see the best deals here in energy stocks with a 24% potential upside to targets, while also trading at a price that's under their long-term average. Stocks in the energy sector trade for just 14 times PE ratio. That is a 6% discount to that long-term average. We also see a relatively good deal here in healthcare with an analyst upside of 19%, also trading cheaply against its long-term average PE ratio. And here communication services with a return upside of almost 19%. Trading just 6% above its 10-year PE ratio, here at 17.7 times price to forward earnings. So focusing on just these three sectors, energy, healthcare, and communication services, narrows our list down from more than 6,000 stocks to less than 500, and again, a hell of a lot easier to find the few that are gonna make money. First on our list is in the energy sector, Chevron, ticker CVX, a stock I highlighted Wednesday as one of the most dependable dividend stocks you can buy. And here, while the return to the average analyst's price target of 17% is the lowest on our list today, that's not counting the 5% dividend yield, which puts you at a 20% plus upside on a stock that's safer than most. While a full-on recession would see the price of oil drop closer to $50 a barrel and hurt all the stocks in this sector, we already see that energy stocks are trading very cheaply, and Chevron benefits in the downturns by being one of the most efficient in the industry. The company produces one of the highest returns on capital expenditures, an ROCE ratio of nearly 8%. That means it's getting more revenue from spending than just about any other company. It also prioritizes shareholder cash return, increasing the dividend by almost 6% a year and growing it for more than 38 consecutive years. Chevron's global scale and its assets across the entire energy ecosystem helps protect that cash flow, and it's going to take these shares back to last year's peak of $170 in a rebound, all while you sit back and collect that 5% dividend while you wait. We're just getting started with our best of the best stocks to buy, but being in front of these kinds of stocks means staying up to date with the news, and for that, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign-up link below. Back to our list though, with the first stock in the communication services sector and shares of Meta Platforms, ticker META, and I found something here that could really surprise the market over the next few years. Of course, we already know that Meta dominates social media with over 3 billion users just on its Facebook platform, but also another 2 billion on Instagram and WhatsApp platforms, and while some of this is overlap, there's no other social company that even comes close to that kind of reach. Meta is expected to post good, not great, but very good revenue growth of 13% this year and next, and 9% annualized growth in its earnings as it spends heavily on that AI and its other projects. The valuation here hasn't moved much from about 9 times on a price-to-sales basis because Meta hasn't sold off like the rest of the market, down less than 1% from the beginning of the year. And there's an untold story here that could see these shares highly underestimated. First is a bifurcation in the advertising market that I've noticed through earnings reports. While other ad-driven companies like Snap and its Snapchat platform have gotten slammed on fears of lower ad spending, shares of Meta jumped when it reported a surprisingly strong ad revenue outlook. So what we're seeing is, faced with having to cut ad spending budgets ahead of a consumer slowdown, advertisers are triaging, cutting from the lower tier platforms while keeping that ad spending or even increasing it on Meta platforms Facebook and Instagram. That gain in market share is the jab, and an article in The Verge last week could be the big right hook that KOs any Meta competitors. The article by Nilay Patel, editor-in-chief of the site, was meant as a warning, but for investors, it's a big dollar sign pointing right at Meta. In that, Patel translates an interview Zuckerberg did recently about the future of AI and advertising, where Zuck pretty much outlines the company's plan to wipe out the entire advertising industry, using AI to create an endless number of content pieces for testing and delivery. Here Zuckerberg says, we're going to get to the point where you're a business, you tell us what your objective is, you connect your bank account, you don't even need any creative, you don't need a demographic, you don't need any measurements. Nation, this is much bigger than it appears. First, we know that Meta is gaining that market share from rivals in an ad spending slowdown, but put it with that AI future and you have Meta moving even further into the total media ad spending ecosystem, a $1 trillion market and with very real plans to take everything. So here, that $186 billion revenue forecast for this year may be a fraction of what the company could book over the next few years. And that's why I think analyst estimates are grossly underestimating the shares here with an average $700 price target. That might work for a 1-year target, but there's going to be a time very soon that even that price looks like a steal. Google parent Alphabet, ticker GOOG, is also in that communication services sector, but getting hit harder lately than Meta, now down 20% from the February peak. But here's the thing, the big worry for investors may be the biggest upside return potential. Alphabet easily beat its earnings expectations, posting 12% revenue growth in the first quarter, with profits surging 48% when it reported last month. The company also unveiled this year's share buyback program, buying back as much as $70 billion in shares, which alone would be a 3.5% return to investors, but also boosting the dividend by 5%. Now, investors, though, have rushed to the exit this year as court rulings pile up, accusing the company of a monopoly and threatening to break it into pieces. But here's where it gets interesting. Not only did I show you in our May 28th market update that Alphabet is the least expensive of the Magnificent 7 stocks, trading at just 20 times on a PE basis and just 5.7 times on that price to sales. a discount of almost 50% to the group's average, but also showed you how split apart the 5 segments would be worth a combined $4 trillion market cap, a 100% return from the current stock price. Now, I'm going to link to that video in the description below so we don't have to rehash all the analysis, but just by using a very simple price-to-sales comparisons with companies in those 5 core segments, takes shares more than double from where they are right now. Now, understand a breakup would be years away and still unlikely, but even to the average price target we see here with a 22% upside on the shares of Alphabet, and what could be a lottery ticket in the company's Waymo self-driving segment. In the healthcare sector, I pointed out the opportunity in shares of Insulet Corporation, ticker PODD, in a September video, with the stock up 29% since, and still relatively cheap. Shares here crashed as much as 55% in 2023, when investors feared that those GLP-1 weight loss drugs would get everyone off their diabetes and other weight-related medications. But with side effects being reported and the burden of that weekly shot, it's clear now that those weight loss drugs like Ozempic are not the cure-all to obesity. Insulet sells the #1 prescribed automated insulin device in the United States with over 250,000 users globally, and the total market for these devices is in the tens of millions, so we have Insulet, a market leader with lots of room to grow. That's driven a 20% plus growth in annual sales over the last 5 years, forecast to continue for that 18% this year and next to $2.9 billion. And this one is still relatively cheap on its valuation, leading analysts to an average target of $318 a share for a 23% upside from the current price. Even the lowest analyst target is for a positive return. This next stock has a 44% upside to average analyst target, and that's not even counting the 8% dividend yield. But as strong as these stocks are for the year and longer investments, the next few months could be extremely ugly. In fact, I recently shared a confidential presentation by one private equity firm showing you a roadmap to the next recession. Nation, you need to watch this video linked in the corner or look for the link in the description below, why the next market crash is just 33 days away. Our second stock here in the energy space, Energy Transfer, ticker ET, which along with its 8% dividend yield, has produced a 224% return over the last 5 years, more than 26% a year. ET is one of the largest and well diversified among the Master Limited Partnerships, or MLPs, companies that own oil and gas infrastructure like pipelines, storage, and transportation. From these, they collect fees from energy companies using those assets, so while performance is still tied to oil prices, that fee-based income helps shield them from some of the worst sell-offs you see in the drillers. And these MLPs get a special tax break if they pass on most of their income to investors, so you get that high and very stable 8% along with the price return. Now, the downside with these is that you do get a special K1 tax form for these, and taxes are handled differently from other stocks. It's a little confusing the first time you file, but the upside is most of that dividend you received isn't taxed. It's considered a return of capital instead of a regular dividend, where you'd pay those capital gain taxes every year, so well worth the hassle here. Now, beyond that tax advantage dividend, the drop in the shares on this year's plunge in oil could mean a strong upside return. Among the 11 analysts surveyed, the average price target of $23 a share is 44% higher. Even the lowest target would be a 25% return on top of the dividend. Get the weekly bow tie and stay up to date with all the stock market news, trends, and stocks you need to see, all free with the invite link in the description. Or click on the video to the right to see why the next market crash could be just 33 days away. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.